All right, everybody, we're going to be diving into a stock that is heavily sensitive to the Canadian economy and is one that I have actually covered for probably 7+ years now, and is a company that I've made quite a few videos on and have turned a bit bearish on over the years after being extremely bullish for many years, and that is GoEasy Limited. So I'm going to dive into the quarter. I'm going to give my comments on, a little bit of the issues that we're facing with the Canadian economy and some potential warning signs in the company's quarter that kind of give an indication that we might be seeing a bit of rollover in this regard. So if you like the video, head down below, like it, subscribe to the channel, and comment down below. I give away free premium subscriptions to random commenters. As long as you're subscribed to the channel, I would send you a message and you get a free year to our Stocktrades premium subscription, which is a $300 a year platform. And as always, I got a wide variety of case studies and stock research in the description below. You can grab absolutely free, but let's dive right into it. So I do want to give a little bit of context on GoEasy before I start this video, and that is when I kind of pulled my coverage of the company from Stocktrades Premium, and this would have been back in August of 2024. So we send out this weekly premium newsletter, and I pulled GoEasy from our bull list back in August. So again, they had a strong history on our bull list. We first highlighted in 2018 around a price of $32 a share. So we're looking at, at the time the company was, I believe, $200 a share. So it had some very good returns. But I mentioned, if you follow GoEasy, you might have noticed over the last few quarters, the company is putting up some exceptional growth, often 20% in terms of both revenue and earnings. So despite this, its stock price has been relatively flat since April. And in my opinion, this is the direct result of overall economic situation and the uncertainty about the health of the Canadian consumer. So we go over the loan originations here, which have absolutely skyrocketed over the last few years, especially in the pandemic era. And, the subprime market, it's witnessing some explosive growth, or at least it was. And although this is good for GoEasy overall, I mentioned there's a fine line here. During weaker economies, many consumers who are strapped for cash will head to those subprime markets to access more capital. GoEasy and Propel Holdings were some of the best performing Canadian stocks on the market over the last few years. Obviously this isn't the case anymore. GoEasy was around $205 a share at this point in time, and right now we're sitting around $148 a share. So it has faced some pressure. Charge-off rates are creeping upwards. They actually reported a bit of a recovery in terms of this over the last quarter. And then we look to the credit quality and HELOC loans. I'm going to discuss this more in the earnings, so I won't go over it all that much right now. But then I look to the fact I had mentioned that the company is fully valued. So I had mentioned, if GoEasy was trading at a level of discounted valuations, I may have viewed that situation differently. But at the time, it was trading at pretty much average valuations, 10-year medians. It was trading at 12.17x, and its median average was 12.10. So I did view the company as fully valued at that time, and I ended up removing it. And the company continued to report some pretty strong quarters over the while, but its stock price continued to dip and dip and dip. And the primary reason for that is the market is generally forward-looking, and I do believe there was a lot of stress put on the Canadian economy that might be showing a bit in GoEasy's earnings at this point in time. So let's dig into the conference call and the earnings report. So we have revenue of $392 million. So that was up 10% year over year. That actually exceeded analyst estimates, I believe, a little bit. And actually, I'll go back to the estimates here. We can actually see that it was a slight miss on revenue. And in terms of earnings, it was a big miss. Again, I've covered this company for 7+ years, and this is probably one of the biggest earnings misses I've seen from the company. And it was due to a lot of margin pressure, some escalations in bad debts, and overall loan originations declining. Now, when we go to the loan growth, so they originated $670.7 million in loans. This exceeded their guidance. However, when we go to the actual loan originations over here on FinChat, we can see that it actually declined. So we're looking at March 25th, 676 million, and we look to March 2024, we're looking at 686 million. Now, it is really not that typical for GoEasy to report a decline in year-over-year originations. It has not done this for quite some time. So we can look to March of 2023 right here, 615 million in originations. When we look to March of 2022, 476. When we look to March of 2021, we're looking at 272. So it's skyrocketed from that point. And then when we look to March of 2020, we're seeing growth there as well. We have 241.6 million compared to 272. So this is definitely the first quarter that the company has reported year-over-year declines in loan originations in quite some time. And there is a logical reason to this. The company is likely going into conservative mode here due to the overall macro environment, because the one thing about it is overall applications for credit, and FinChat actually does not have a KPI for this, but overall applications for credit were up 10%. So more people are applying for credit. That is still growing, but originations are falling, likely because the company is tightening up a bit in terms of its lending practices, probably because it expects the economy to weaken moving forward, and it expects possibly provisions for loan losses to accelerate. But ultimately, this is not necessarily a huge ordeal because it's not exactly a decline in loan originations because applications are falling. It's more so the fact that the company is likely being a bit prudent here and scaling this back. When we look to originations on an annual basis, obviously the company is still doing very well, but we're seeing the last 12-month originations, they are dipping below December 2024's levels. So that's something to keep in mind. Application volume is still growing, but it's not growing as fast as people are starting to really scale back their spending. So if we head back to the results here, we're looking at unsecured loans. They accounted for 62% of originations. So secured loans, including home equity and auto, reached a record 46% of the portfolio, reducing overall risk exposure. How exactly does this reduce overall risk? Well, secured loans are obviously backed by an asset. If you don't pay your home equity loan, they will eventually take your home. And if you don't pay your auto loan, they will eventually take your vehicle. So these are a bit more stable loans. They have an asset to go after if the person does not pay it. However, 62% of loan originations unsecured last quarter is, they're definitely the riskiest loans because they're not backed by any sort of asset. They do carry the highest rates of interest, there's no doubt about that, but they are also the riskiest. Now, a few years ago, the company got into automotive financing and originations hit a record 150 million. That's up 30% year over year, with their dealer network surpassing 4,000 locations. So I could actually see the subprime market for auto lending continuing to grow just because of the price of used vehicles now. It's not really something you can just go out and dump a bunch of cash on, because I'm going to be completely honest, junkers are going for thousands and thousands of dollars. So I could see this continuing to accelerate quite a bit. And when we look to home equity loans, those are up 29% year over year. So they say it's primarily used for debt consolidation and home repairs. And most of their HELOC loans have 65% LTV ratios. So effectively, this is the loan to the value of the home. So if you have a $1 million home and you have a $650,000 mortgage, your LTV is 65%. There's around $350,000 or 35% in equity in the home, which is ultimately the better loan, because in the event the home has to be sold or GoEasy has to take over the asset, it can recoup its capital a little bit earlier. Now, portfolio yield, this is going to be a big KPI for GoEasy. It's 31.3%. So that was down 30% from a year earlier. And what is happening here is, if you'll remember, I believe it was a few years ago, the government has implemented restrictions to kind of cap the maximum interest rate that GoEasy can offer. So this isn't the entirety of what has happened with the company. It's also seeing secured loans. As its secured loans grow, you're going to see the rates go down because the company will not charge as much interest on a HELOC as it would an unsecured loan. So that's kind of a element of it as well. So it's not necessarily all a bad thing because yes, the yield is falling, but also the loans are more secure. They're backed by an asset. So this is kind of a mixed signal here. Nothing overly concerning right now, but is something that is definitely going to hit overall profitability. So let's go over credit. So the average customer credit score for new originations hit a record 632. So 632 is not a good credit rating. It's an very average credit rating, but for a subprime lender, this is actually probably a good thing. So more high quality borrowers are coming to GoEasy to get loans. So this can be taken as a good sign. I actually view it as a bit of a soft sign, not necessarily in terms of GoEasy, but in terms of the overall Canadian economy, because ultimately the higher quality borrowers that are having to tap the subprime market is not a good thing. This is a company that people typically go to when they are on their last legs. You don't go to subprime lenders because, you like the business. You go there when you cannot get loans from prime borrowers. So your interest rate is higher. You're going to pay more with a company like GoEasy. And as mentioned, I think it is bullish for GoEasy, but very bearish for the Canadian economy overall. When we go to loan loss provisions, so those increased to 7.86% from 7.61. So obviously, loan loss provisions, these are substantially higher than many of the Canadian banks, but that makes sense. Canadian banks are prime borrowers. They have the highest quality borrowers in the country for the most part. The people who get shut down from the major banks are typically the ones that go to GoEasy. So obviously these loan loss provisions are going to remain elevated. That's really not that big of a surprise. So we have net charge-offs at 8.9%. Now this is lower than last quarter and is well in line with the company's guidance. I'm actually surprised to see this not tick up because of the current environment. So we look to impaired loans, they're down to 6.9%. So this can be from stronger collections from the banks and just overall better underwriting. Getting better at actually analyzing and giving loans out to consumers is ultimately going to reduce the amount of loans you have to write off. So from the conference call, we're looking at some comments made by the company in terms of their overall commentary on the economy. So they state they'll have to adjust to the 35% interest rate cap, which obviously impacted their yields. However, they will eventually normalize this out. They do eventually want to get this down to a normalized level, and they said they should be able to do so, and they will be eventually able to drive profitability even in a lower rate environment. And they also mentioned that they are benefiting from tighter lending conditions among prime lenders, leading to higher quality customer inflow. Again, the big banks are tightening up their lending practices substantially during environments like this. And ultimately, that should benefit subprime lenders, but again, is a sign of a relatively poor Canadian economy. And they did mention this as well. They're pretty cautious on the overall environment, particularly the tariff impacts, the increased delinquencies in their loans, and a weakening Canadian GDP, which definitely could be amplified moving forward because of tariffs. So overall, it was one of the weaker quarters for GoEasy I've seen in quite some time. When we look at interest income, it declined on a sequential basis. If we look to leasing revenue, that declined on a sequential basis again. That has actually had a consistent, steady decline. But this is really not all that surprising because of their Easy Home segment, things like that. And when we actually look to Easy Home, which is a relatively small portion of the business, this is really not the company's premier product. This would be when you can go and, finance a PlayStation or a couch at just rates that will blow your mind. It continues to decline. However, the company's main focus is going to be on that easy financial revenue. And although it is relatively steady, this is actually, the first time we've seen a decline since, the middle of the pandemic, effectively. So the company is tightening up its loans. It's tightening up its credit quality significantly right now. And over the short term, this might impact earnings, but over the long term, it's likely a better situation for GoEasy to be doing this. And when we look to the total yield on products, we're seeing a pretty substantial decline from pre-pandemic levels. And most people might take this as a bad thing, but again, it's probably due to that loan portfolio containing a lot more secured options, HELOCs backed by the home, automobiles backed by the actual car. So they don't need to charge as much interest to ultimately drive profitability while mitigating risk. But there is also the added element of that rate cap in this, which will eventually, ultimately hit their unsecured products. So it's definitely something to keep an eye on as this continues to tick downward. But the company also did mention that in their recent guidance that, they expect the yields to be maintained at this level, but we'll see what happens. So the final thing I'm going to talk about here is just some overall quarterly numbers. So we come down here, we're looking at, again, 46% of the portfolio is secured. As I had mentioned, applications for credit up 10%. New customer volume up 8%. These are lower numbers than typical, which gives the impression that things might be slowing down a bit. And when we look to operating income, it's only up 1%. So on their Easy Financial segment, it was down on their Easy Home segment. And overall, the operating income is being impacted from a decline in operating margins. So if we come down to overall operating margins, where is it here? We can see their Easy Financial operating margin, it fell by 440 basis points. When we come to their return on equity, it actually fell by 420 basis points down to 20.4 from 24.6. This is still an outstanding return on equity, but it's definitely dipping. And in terms of bad debts, the company is continuing to report some pretty high accelerated growth in terms of bad debt. We're looking at $105 million in the first quarter of 2024, and now we're sitting at $131 million. That is a 25% increase, and it actually did increase quite a bit from the last quarter as well. So overall, there's a lot of pressures here on GoEasy. This, I will put it bluntly, was not a very good quarter from the company. And if the economy does truly indeed roll over, we enter a recession, I do think there could be more downside here. Again, when I talked about it back in August and July, when I actually ended up kind of pulling the coverage on the company, I kind of stated that the trends in the economy were kind of highlighting the fact that it could get pretty rough going forward. Now, do I believe GoEasy is an outstanding company for the long term? Absolutely. If you want to buy and hold this thing through the volatility, that's perfectly fine. We've witnessed a lot of it over the years and they've come out on top every time, but we can also look back to significant drawdowns in price. And we come back here to 2018, we're talking $51 a share and it fell all the way down to 32 in like the matter of 2 months. We're coming to the COVID-19 pandemic, which I don't expect the environment would get this bad, but we're talking about $79 all the way to $29. We're talking 2021, $217 all the way down to $100. There's going to be large scale volatility here, and there's no issues with just kind of waiting to see if we get a bottoming of the economy, because I will tell you right now, if the economy gets weak enough, this $147 share price is not going to hold. A company like GoEasy, we've seen it time and time again with the volatility, we could easily see sub 100 here. Now, it's very hard to predict the direction the Canadian economy is going to go in. So again, if you wanted to buy the company and hold it over the long term, I do believe you will be fine here, but you also need to acknowledge the fact that if it gets much worse, this company could see $100, $90, $80 a share very quickly. It is not out of the question. There will come a time where I add this company back to our coverage list over at Stocktrades Premium because I really do like the company. I just don't think right now is the time, and I can acknowledge the fact that GoEasy is an outstanding long-term hold, but maybe not the best time to pull the trigger on at this point in time until we see a bit of clarity. But ultimately, you are free to do what you choose with your investments. And a lot of people get the impression that I don't think this is a high quality company just because I would not pull the trigger right now. That just isn't the case. But that's it for the video, everybody. Hope you liked the earnings review of this company. Head down below, like the video, subscribe to the channel, comment down below. Remember, I'm giving away those free premium subscriptions to commenters of the videos. I'm going to select a couple random comments on the videos I produce this month, and I'll give away some subscriptions at the end of the month. And as always, I got all those free case studies and reports down in the description. You can grab them absolutely free, and we'll see you next time for more great Canadian content.